Valuations. Valuations are close to everybody, believe it or not. And, you know, because most of us probably have a house and probably have a car, and there's valuations tied to that. And incidentally, one thing that I should say before we start, you know, this, as the title slide says, it's for early stage companies, and most everybody here is early stage, but there's a few that are beyond that point. So probably not going to find this that interesting if you're beyond early stage. Okay, this is really for the early stage companies that are here, and I think that's majority, but there are a few outliers here too. So okay, so valuations for your real estate and your car. Just unmute yourself. How is your car valued or your house valued? Just jump in there and throw something out.
Oh, so
Hello and Zillow and Edmunds is what I look at.
Kelly Blue Book.
comparables.
Yeah, exactly right. It's kind of like set by the market, right? It's all comparables, right? Your value of your house is valued because of the next house and so on. There's some geographical influences in your residence, right? So your house here, if you just pick it up and move it to Atlanta or Boston or whatever, it would be worth something different, right? Just because of the geography, right? But again, comparables, I think that was Bob that said that. So it's definitely set by comparables. So for startup ventures, okay, valuations are voodoo, okay? If you're looking for science in establishing a valuation for your early stage company, you won't find it. You won't find it. You do need some facts. I'll talk about that, but valuations are voodoo. And as an investor, you might look at something and the valuation might be X, and another investor is going to look at it and say, it's not X, it's X times 2, okay? There's just no science in this, okay? So I think that's a good baseline to start with, that you have to understand that there's really no science that's put into this. Okay, so the impact of your valuation, when you say that your company is worth, pick a number, $5 million, okay, that impact is carried throughout the life of your company, okay? And it's very hard to unwind that. So every investment dollar is based on what you say your company is worth. Okay, so you want to get this right in the beginning, okay? So I said now and for the lifetime of the business, don't look for the science that's not there. Always be able to substantiate your valuation with facts. And I'll talk more about that, how you can do that, because you definitely need to do that, okay? An important factor here, the capital requirements of our business are almost always more than envisioned. I think Peter's heard it before, Desert Angels. I heard it before when I was on the Desert Angels. There's always companies that come in for their first round and say they need $3 million worth of cash or $1 million worth of cash, and that's all they're ever going to need. And that's always not true, because you always need more money than you think. And what happens there, I mean, just a simple example. I mean, if Anita owns half of a business and I own the other half, and all of a sudden we don't have enough money and we need to have George come in and give us some cash, well, now the three of us own a third of the company. So now we get diluted, okay? So we own less and less, okay? And then when we spend George's money and we need to bring in Bob's money, now we own even less, okay? So we get diluted some more, okay? So businesses always need more than they initially think they're going to need. Okay, just some fundamental terms, okay? Pre-money and post-money, maybe this is old school for some, but it's worth talking about this, okay? Your post-money valuation, okay, is your pre-money plus the new money from around, okay? Here's an example, okay? You're going to raise $200,000, definitely within reach of angels and in some cases, friends and family, at a $2 million pre-money valuation, okay? It implies 2.2 million afterwards, right? Or post-money valuation, right? So you have the two together, okay? This is another way to look at it. You don't hear this quite often though, but selling 10% of a $4 million post-money valuation means $4 million times 10%, which is $400,000, okay? And that implies a 3.6 pre-money valuation, okay? At UACI, and I'm sure all the companies that are here today, your concern is really about the pre-money valuation. When you look at the other side of this, when you look at the investor side, the investors are always concerned about the post-money valuation, okay? So just different areas of focus. Okay, so when you look at the investor's ownership, okay, the percentage ownership is the investment amount divided by the post-money valuation. Again, this is from a investor's perspective now, okay? A couple of examples here, right? So the business is raising $400,000 at 1.6 pre-money. You invest $1,000, that's all, $1,000 in common shares. How much do you own, okay? So you determine the post-money first, so it's 400,000 plus 1.6 million or $2 million post-money, and then divide your investment by the post-money. So 1,000 divided by 2 million, okay? You own 0.05% of the company, okay? What if the business was raising the same 400K, but out of 1.6 post-money, okay? So now you take your $1,000 divided by 1.6 million, and you own 0.0625%, okay? Which is 25% more than pre-money, than the pre-money case, okay? So when you look at these examples, you could see how when your pre-money, okay, is lower, okay, investors typically are getting a bigger chunk of your company, okay? May not be a huge chunk, but they're getting more, okay? When your valuation is higher and they look in their wallet and only have $1,000 or only have $1 million, depending on what your valuation is, they're going to get less. And they look at that before you even go any further and try to make some assessment as to whether they want to do this or not. It's important to note that investors could look at a particular company, and I know this has happened to me before, probably happened to Peter as well in Desert Angels, but someone might say, gee, I got a brand new startup company. I think my valuation is $500,000. Are you interested in hearing more? Okay. Just based on that number, an investor can make a determination that's a very early stage company, probably a lot of risk, also a lot of reward, possibly a lot of upside too, even though the valuation is very low. Okay, there could be a lot of upside there. And an investor might say, well, yeah, okay, let me take a look. Okay. Another phone call, startup company says to an investor, my valuation's $4 million. Okay, we have some friends and family money already invested in a company. Would you be interested? Well, at that valuation, an investor might say, well, this is probably beyond very early stage, still early, but beyond very early stage. And maybe that's an area that I'm interested in. Okay. Still lots of risk, but also lots of upside there too. You raise the stakes a little bit higher, and an investor gets a call and says, hey, my company has got a valuation of $20 million. Would you be interested in taking a look? Well, an investor might say, boy, this is right in my sweet spot because I don't really like taking a lot of risk. There's probably lots of other stakeholders and investors in there already, which is good. I'm probably in for a little bit of gain if there's anything there, and I like this. Likewise, an investor can say just the opposite. This is way too far along for me. I really like gambling, okay, down at the low end, okay, because the reward could be much greater, even though the risk is also greater. So investors kind of hear these numbers and then try to make some decision. So if you guess, just take a wild guess and say, yeah, my business is worth $50 million. Do you want in? Okay. An investor might say 50 million. Oh, you're way too far along for me. Thanks, but no thanks. Okay. And then you run into this person, or they see you at a presentation, a couple months later, and they recall you saying that the business was worth $50 million. and they hear you maybe getting ready to make an angel presentation for a couple $100,000 and say to themselves, something doesn't add up here. Told me his valuation was $50 million and he's looking for $200,000 from Desert Angels. What's with that? Okay, that's a bad guess. That's a bad guess. And what happened is in the beginning, when you presumably incorrectly said your business is worth $50 million, you scared away a potential investor because they just said, oh, you're way too far along for me. Okay. So now when they see you appealing for $200,000 from angels, they're checking out again because they're saying something's wrong here. Something doesn't add up. This particular person didn't do their homework and getting their valuation right. So I'm out. So you lost an investor that might have been a good partner for you too at the beginning if the number was right. Okay. Okay, let's go on. I don't have that many slides, by the way, which is good. So how's our time? We're doing okay? Yep. All right. So influences on the valuation. There's a bunch. I just put down like I don't know, 9 or 10 of them on here. But some investors want to be on a board. Some investors, I'm beyond that point. I don't want to be on the board because board investors have fiduciary responsibility. So that's work. So I mean, that means nothing to some investors. To some investors, it means a lot. Okay. All these other factors that are here, I probably got more in here. Geographics means a lot. I mean, a bio company in Tucson, Arizona, and a bio company in Boston probably has a different valuation just because of the geographics. Okay. I'm picking on electronics now, electronics company in Tucson versus Silicon Valley, or software company here versus Silicon Valley, probably different valuations just because of the geographics. Okay. All redemption rights and drag along rights, preemptive rights. I'm not going to touch any one of these today on this call. This is like way beyond early stage valuations, but these are part of a whole slew of factors that are involved with investors that are initially looking at your company. Okay. And thinking about providing a term sheet to you, which is a conversation that happens long after the valuation comes out. Okay. Okay. So you want to focus as an early stage company, you want to focus on your pre-money valuation. You want to get that right. Okay. So here's the meat of this whole thing. Okay. It's right here. Okay. Simple and generally accepted guidelines that are here. These 5 factors really set the baseline valuation of your business. Okay. So, and each one of these factors has, roughly speaking, a maximum of $500,000 in value. So if you score a 10, let's say on all 5 of these, you have a $2.5 million business. Okay. So let's pick these apart a minute. I mean, a sound idea. Well, what's a sound idea? Is it a new pair of sunglasses? I don't think so. That's not a very sound idea to me. Okay. But if it's a great application, it fills an unmet need in the market. That's great. That you could get $500,000 in valuation right there if you have a great idea. But your great idea and your assessment has got to be translated into a great idea in the investor's assessment too. So, the two go together. You might say $500,000, I got a great idea. An investor might say, it's good, but it's not that good. It's $300,000. Okay, fair enough. That's it's the investor gets to determine that. Okay. Quality management team. Okay, another $500,000. Okay, who's on the team? Said before in a presentation, maybe it was mine, that there's no such thing as a founder. There's only co-founders. That's true. Okay, but beyond that, who's going to run the company? Even if they're part-timers, they're contractors. In some cases, you might have commitments from people that are currently working a day job, so to speak, but they're willing to leave that day job to work in your company when it gets to a certain point. Okay. So who's on the management team? What kind of experience do they have? How committed are they to see the venture forward? A lot of these questions come up. Okay. Again, $500,000. based on a team, an investor might say, gee, there's one founder, there's not even a co-founder, and there's one other person in the company that is not really on the C-level suite at all. They're kind of down the food chain a little bit, so to speak. This is not a $500,000 team. This is more like $100,000 team. Okay, be prepared for that. Okay, this is one of the factors. Okay, prototype is number 3. Okay, if you have, and this can be difficult, especially in businesses that require a lot of capital investment, even just to do a model. Okay, but a prototype, if you have an app, something manageable in size and money that you can actually show to an investor, that's huge. That takes a lot of risk out. When you have something that is going to take the space of a high-rise building and going to cost $10 million to build, you're not going to do that out of your own pocket. Nobody expects you to. But what that means for an investor is that there's some risk that you may not be able to do that. You may think you can, but an investor is looking at this saying, it's a lot of risk. If I put my money in here and something doesn't come together, I've never even been able to see a model or a prototype yet. This is a bad risk. Okay.
Thank you.
So
have a good one.
that's another $500,000. So if you are fortunate enough, depending on what your business is, to be able to show a model, that's fabulous. Great. Okay. Strategic relationships. Again, that comes with having partners in the industry, okay, that you know, consultants that are helping you out, being able to identify who the competitors are. If an investor surprises you and says, oh, is your product like so-and-so's product, and they're a legitimate competitor and you don't know who they are, that's not good, okay? So, you know, strategic relationships in your industry, in your area of product concern, very important. Another $500,000 for that. And last is product rollout or sales. And I should add to this that it's not really sales in dollars as much as it is sales in customers. Do you have customer number 1, number 2, number 3, even number 5, even if they're small, it's okay. They're taking some risk away, okay, from the investor that they've already given you an order, given you money for your goods. Be careful if you have the ability to maybe consult with another company and sell your expertise to another company while you're trying to get a product up and running. Those aren't sustainable sales. Okay, so be careful if you tell an investor, yeah, I got sales, and he says, okay, so who are the customers? Well, it's someone totally out of the industry. They asked me to help them with this particular problem. Well, you're just consulting then. You're not selling anything that's coming out of your business. Okay, so if you have sales, again, it might just be 5 customers, might be 3, might be 30. That's okay. That's good because they're taking risk away from the investor, which is a good thing. So again, another $500,000 here. Okay, so this whole list, like I said, if you score a 10 on everything, you know, $2.5 million minimum right there. So $2.5 million. Coming back to those examples I said before, you know, where you have an investor getting calls for $500,000, $5 million, or $20 million, you know, you could see how a $5 million call is fairly early stage here with a couple of additional benefits, additional valuation dollars that have been added in. So what could those additional benefits be? Well, keep this list in mind first, because if you don't have a sound idea and you add some benefits to it, that's for a particular investor, that could still be a problem, because some investors are going to say, boy, if you don't even have a sound idea, even if you really have a great team and you sold a few widgets already, I'm not sure how long this is going to last, but as an investor, there's way too much risk here for me. So let's look at some additional things that you might be able to add to that, okay? Patents. If you have a patent, that's great, okay? If you have a patent that you're using, even better. If you have a patent on some some part or whatever that you're not even using in your product, well, that's not going to really help you that much. Okay. But you have gone through the rigor of filing a patent and everything else like that. So an investor might say, okay, well, that's might be worth $100,000. If you have a patent on your product and you're even considering licensing that patent maybe to another country or whatever to make your product, oh, even better. Now an investor might say, gee, that's worth 200 or 300K, maybe more. Okay, so patents could be worth something. Okay, depending on which stage it is too, could also delineate how much it's worth. Okay, SBIRs, phase one, phase two. SBIRs to an investor say, okay, well, the government's willing to take this risk, okay, before I am. So that's good. Now, everybody knows, well, not everybody, but people that have gotten to phase one probably know that, there's still a lot of risk in a phase one that you're going to get there. When you have a phase two, that's better, okay? When you have more than one phase one or phase two, even better, okay? Still nothing like sales, okay? But if the government's willing to give you money based on your idea, that's definitely a plus. Okay, friends and family investment, okay? If there's one person that gave you $1 million, that doesn't de-risk it a lot, because typically that one person is probably a close relative of some sort, some very good friend. I picked a nice high number there to make my point, okay? But, if you have 10 friends and family that each kicked in a little bit, well, that's better. That's better than one person that kicked in a whole lot, okay? Because again, you're pulling some of that risk away, because 10 people, even though they're friends and family, okay, which you got a discount for that, but 10 people putting somebody in says that they endorse your idea. Okay, awards like AIC. I just threw a few out here, like AIC, Idea Funding, Flynn Foundation. There's others out there too. If you've gotten non-dilutive funding awards, that's good. That's an upper as well. You have to be careful, like for instance, Flynn Foundation, we know in Arizona, okay, but if you were talking to an investor in Boston, you said you received money from the Flynn Foundation, it wouldn't register with them at all, and you'd get no credit for that. So that's just one of those geographic differences, okay? But any awards that you got are definitely helpful. So, if you're the historian, so to speak, for your business, keep these things, write them on the wall, all your accomplishments, because they could mean a great deal to a potential investor. Okay. Private investment. If you've taken some money from a private investor, happens frequently. Okay. How many do you have? It's not really how much money that they put in, it's how many private investors you have, because again, private investors are de-risking it for other investors. Okay. Last year I said the future market or the future company can be a negative, but it's rarely a positive. Okay. So when you tell an investor that you're in the hottest market in the world and everything, you're going to be the first company to cure cancer. How many years have they been hearing that, right? I mean, company after company has said that. It hasn't happened yet. Okay. So it really means little. Okay. But likewise, if you said, you're going to come out with the greatest sunglasses in Arizona, well, that could also be a negative. So, it's rarely a positive, but it could be a negative depending on your market. But just because you're in a fast growing market, it still doesn't pull the risk away for an investor that you're going to be the one to hit a home run for them. Okay, so next steps. First, let us, I said us, let UACI help you with your valuation, okay, before you start looking for investment, okay? It's very helpful to get us involved. Let's see where you're at. Let's talk about what you think your number is, and we could start asking questions about, well, do you have this, and you have this, who are you going to use the number with? I mean, if it's just for you at the moment, well, okay, you're not going to do any damage with that, but if you're thinking about going to angels or some other investor, you want to get that number right, because as I said before, if you get the number wrong in the beginning, you might say goodbye to this investor right away. Okay, so you want to get it right. Okay, your valuation of your business, even though we just talked about it for the last 15 minutes or so here, is really just a function of how well you're running a company. Okay. If you run your business and run it well, your valuation is going to go up because you're going to make, good decisions. Okay. So you're going to make good decisions to get, a good team in there. You're going to select the right products to put out in the market. Okay. You're going to have customers, you're going to have sales. Okay. You're going to set up your board of directors right. You're going to market your product right. Okay. So if you just run your business right, your valuation is going to go up. You don't have to put a separate focus on jacking up your valuation. It'll happen by itself if you just run your business right. Okay. The more risk you can remove from the business, the more attractive you will be to investors. Okay. And again, that's a function of running your business the right way.